We live in a world that revolves around money. We earn it, spend it, save it, and constantly think about it. But how many of us truly understand the language it speaks? That's where accountancy comes in. Think of it as a translator for your money. It takes all your financial transactions and turns them into a clear picture. This financial snapshot is crucial for everyone. Understanding the basics of accountancy can make a world of difference. It empowers you to make informed decisions about your money. Accountancy isn't about complex formulas or confusing jargon. It's about taking control of your financial well-being. It's about understanding where your money comes from, where it goes, and how you can make it work harder for you. In this fast-paced world, we often get caught up in the daily grind and neglect our finances. But just like we invest time in our health and relationships, we need to prioritize our financial literacy. And that starts with grasping the fundamentals of accountancy. Accountancy? That sounds complicated, but trust me, it's not as intimidating as it seems. Start with the basics, one step at a time. The payoff is immense. Imagine managing your budget and making savvy decisions. The beauty of accountancy lies in its simplicity. Organize your financial information, understand the basics, and you'll feel empowered. Before we dive into the world of balance sheets and income statements, let's get familiar with the essential terms in accountancy. Think of these terms as the building blocks of your financial house. Once you understand them, everything else becomes much clearer. We'll start with 5 key concepts: assets, liabilities, equity, revenue, and expenses. Don't let these words intimidate you. They're just fancy names for things you deal with every day. These terms help you understand where your money comes from, where it goes, and what you have to show for it. They paint a clear picture of your financial health, allowing you to make smart decisions about your money. So let's roll up our sleeves and demystify these accounting terms. By the end of this section, you'll be speaking the language of finance with ease. Let's start with assets. In simple terms, assets are things you own that have value. This could be anything from your house and car to your savings account, and even that vintage record collection you've been holding on to. Assets are your valuable possessions, the things that put money in your pocket, or have the potential to do so in the future. They represent your financial strength and security. The more assets you have, the better your financial position. But remember, not all assets are created equal. Some assets, like cash, are considered liquid because you can easily convert them into cash. Others, like real estate, are less liquid because it takes time to sell them. Understanding the different types of assets and their liquidity is crucial for making informed financial decisions. It helps you assess your financial flexibility and plan for future needs. Section 3, Liabilities, what you owe. Now let's talk about liabilities. Liabilities are the flip side of assets. They represent what you owe to others. This could include your mortgage, car loan, credit card debt, or even that money you borrowed from your friend last month. Liabilities are your financial obligations. They're things that take money out of your pocket. They reflect your debts and financial commitments. While some liabilities, like a mortgage, can help you build wealth in the long run, it's crucial to keep them in check. High levels of debt can put a strain on your finances and limit your options. It's essential to manage your liabilities responsibly and strive for a healthy balance between what you own, assets, and what you owe, liabilities. Understanding your liabilities is crucial for maintaining good financial health. It helps you track your debts, make informed borrowing decisions, and avoid falling into a debt trap. Section 1, Financial Statements, your money's storybook. Now that we've covered the basic building blocks of accountancy, let's talk about how we put them together to tell your money's story. This is where financial statements come in. Think of them as your personal financial storybooks, providing a clear and concise picture of your financial health and performance. There are 2 key financial statements you need to know: the balance sheet and the income statement. Don't worry. We're not going to get bogged down in complex accounting jargon. We'll keep it simple and focus on the key takeaways for you. These statements give you a snapshot of your financial position and help you track your progress over time. They're like your financial dashboard, providing valuable insights to help you make informed decisions. So let's dive into these financial statements and uncover the stories they tell about your money. By understanding these reports, you'll be well on your way to mastering the basics of accountancy and taking control of your financial well-being. Section 2, the balance sheet, a snapshot of your financial health. First up is the balance sheet. Imagine taking a snapshot of your finances at this very moment. That's precisely what the balance sheet does. It provides a summary of what you own, assets, what you owe, liabilities, and your net worth, equity, at a specific point in time. Remember the fundamental accounting equation we discussed earlier? Assets equal liabilities plus equity. The balance sheet always follows this equation, ensuring that everything balances out. It's like a seesaw. Assets on one side, liabilities and equity on the other, always striving for equilibrium. On one side of the balance sheet, you have your assets, your house, car, savings, investments, and any other valuables. On the other side, you have your liabilities, your mortgage, loans, credit card balances, and any other outstanding debts. The difference between your assets and liabilities represents your equity or net worth. It's the amount you would have left over if you sold all your assets and paid off all your debts. A healthy balance sheet shows that your assets outweigh your liabilities, reflecting positive net worth. Section 3, the income statement, tracking your financial performance. The income statement, or profit and loss statement, tracks your financial performance over time. It shows your revenue and expenses like a financial report card. Revenue minus expenses equals net income or loss. If revenue exceeds expenses, you have a net income. If expenses are higher, you have a net loss. Section 1, double entry bookkeeping, two sides to every coin. Now let's dive into the heart of accountancy double entry bookkeeping. This might sound intimidating, but it's actually a simple concept that helps you keep your financial records accurate and balanced. Imagine a coin. It always has two sides, right? That's the basic idea behind double entry bookkeeping. Every financial transaction you make affects at least two accounts. It's like a seesaw. When one side goes up, the other side goes down to maintain balance. This system ensures that your financial records are always in balance, giving you a clear and accurate picture of your financial position. It also helps you track where your money is going and identify any errors or discrepancies quickly. Don't worry, you don't need to be a math whiz to grasp this concept. We'll break it down into simple terms and show you how it works in practice. Section 2, debits and credits. Don't let the names confuse you. In double entry bookkeeping, we use two terms, debits and credits. These terms often confuse beginners, but they're simply two sides of the same coin. Think of debit as the left side and credit as the right side of a transaction. When you make a transaction, you'll record it on both sides to keep things balanced. Here's a simple way to remember. Debit, or doctor, increases assets, expenses, and dividends. It decreases liabilities, equity, and revenue. Credit, or key ROI, increases liabilities, equity, and revenue. It decreases assets, expenses, and dividends. It might seem counterintuitive at first, but remember that every transaction has two sides. When you spend money or debit, it either reduces an asset, like cash, or increases a liability, like credit card debt. Conversely, when you earn money or credit, it either increases an asset, like your bank balance, or decreases a liability, like a loan payment. Section 3, keeping things balanced, the golden rule. The golden rule of double entry bookkeeping is simple. For every debit, there must be an equal and opposite credit. This ensures that the accounting equation, assets equals liabilities plus equity, always remains balanced. Think of it like a perfectly balanced scale. When you place something on one side, you need to add an equal weight to the other side to maintain equilibrium. This principle is fundamental to accurate accounting. It ensures that your financial records are always reliable and trustworthy. By following this simple rule, you can be confident that your books are accurate and reflect the true financial position of your business or personal finances. Section 4. Putting it all together. How double entry works in practice. Let's illustrate how double entry bookkeeping works with a practical example. Suppose you purchase office supplies for $100 using your business credit card. Here's how you record this transaction using double entry debit office supplies. Asset, $100. Credit card. Liability, $100. This transaction increases your office supplies asset by $100 and simultaneously increases your credit card liability by $100, keeping your accounting equation balanced. Here's another example. Imagine you receive $500 from a client for services rendered. Here's the double entry debit cash, asset, $500. Credit service revenue, $500. This transaction increases your cash asset by $500 and simultaneously increases your service revenue by $500. By consistently applying double entry bookkeeping to all your financial transactions, you create a reliable and accurate record of your financial activities. This information is invaluable for making informed business decisions, tracking your financial performance, and ensuring compliance with tax regulations. Section 1. Common beginner blunders. Watch out for these pitfalls. Learning accountancy is like learning to ride a bike. You're bound to hit a few bumps in the road before you're cruising smoothly. But don't worry, even seasoned accountants made mistakes when they were starting out. The key is to learn from them and keep moving forward. One of the most common mistakes beginners make is not keeping accurate records. It's easy to let receipts pile up or forget to log those cash transactions, but remember, every dollar counts. Without accurate records, you're essentially flying blind when it comes to your finances. Another common pitfall is mixing personal and business finances. While it might seem convenient to use the same account for everything, it's a recipe for disaster when it comes to accounting. Keeping your business and personal finances separate is crucial for accurate record keeping, tax purposes, and maintaining a clear understanding of your financial situation. In this section, we'll discuss these common beginner mistakes in more detail and provide practical tips on how to avoid them. Section 2. Receipt rebellion, taming the paper trail. Receipts multiply like rabbits. 1 minute they're in your wallet, the next overflowing from your glove compartment. Keeping track of receipts is crucial for accurate accounting. They're your backup documentation for taxes or audits. Establish a system that works for you. Some prefer digital solutions using apps to scan and store receipts. Consistency is key. Choose a system and make it a habit. Section 3. Mistaking personal for business. Keep it separate, folks. It might seem tempting to simplify things by using your personal bank account and credit card for business expenses. After all, it's your money, right? But trust me, this is a recipe for a major accounting headache down the road. Mixing personal and business finances makes it incredibly difficult to track your business income and expenses accurately. This can lead to inaccurate financial statements, making it challenging to assess your business's profitability and make informed decisions. Moreover, commingling funds can raise red flags during tax time. The IRS has strict rules about separating personal and business expenses, and failing to do so can result in penalties or audits. To avoid these pitfalls, it's crucial to open a separate bank account and credit card specifically for your business. This creates a clear separation between your personal and business finances, simplifying your accounting and ensuring compliance with tax regulations. Section 1. Keep the momentum going. Your financial journey starts now. Congratulations. You've taken a crash course in accountancy basics and you're well on your way to mastering your money. Remember that old saying, a journey of 1,000 miles begins with a single step? Well, you've just taken a giant leap. You've demystified the world of finance, learned the lingo, and discovered the power of keeping your financial house in order. But this is just the beginning. Like any new skill, accountancy requires practice and ongoing learning. The more you use these concepts in your daily life, the more confident you'll become. Don't be afraid to get your hands dirty, make mistakes and learn from them. Remember, you don't have to become a certified accountant overnight. Start small, implement one new concept at a time, set realistic goals, like tracking your spending for a month or creating a simple budget. Celebrate your successes along the way, no matter how small they may seem. This is about empowering yourself to make informed decisions about your money, and that's something to be proud of. Section 2. You've got this. Embrace your inner accountant. As you continue this journey, remember that resources are available to help you every step of the way. There are countless books, websites, and even free online courses dedicated to teaching accountancy in a simple and accessible way. Don't hesitate to seek out information, ask questions, and learn from experts. And remember, managing your finances doesn't have to be a chore. Embrace your inner accountant and find ways to make it fun. There are plenty of user-friendly budgeting apps, financial planning tools, and even money management games that can make the process more engaging and enjoyable. Most importantly, be patient with yourself. Learning accountancy is a process, not a race. Take it one step at a time, celebrate your progress, and never be afraid to ask for help when you need it. Remember, knowledge is power, especially when it comes to your finances. By embracing the basics of accountancy, you're taking control of your financial future and setting yourself up for a lifetime of financial success.